Welcome to the third quarter Wespath webinar. My name is Joe Halwax, Managing Director of Wespath's Institutional Investments team, and I'm coming to you from our offices here in Illinois for the second quarter in a row. We continue to work in a hybrid format and remain flexible to the Delta or any other variant. One thing is for sure, our business is more resilient after the last 18 months, and we continue to serve our clients from the office, on the road, or our homes. Today I'm going to give a brief organizational update, cover our work in sustainable investments, and update you on the markets. Also the performance of our funds, and then close it out with an economic update from our Chief Investment Officer, Dave Zellner. Wespath has 3 staff promotions to announce. Fred Huang is now a Senior Investment Analyst. Trent Sparrow is now the Manager of Impact Investments. And John Streeter has been promoted to Analyst for Impact Investments. Congratulations to all of you. In the third quarter, we made enhancements to our client-facing portal. The highlights include more granular information on fees, which are now shown as a separate line item. And there is also more flexibility for account transactions. This includes options for future dated or recurring transactions and more options for same-day transfers and withdrawals. The enhancements reflect the feedback from clients, and we strive to continuously improve our offering for you. Wespath is now GIPS compliant and verified. GIPS stands for the Global Investment Performance Standards, and it's a voluntary standard used in the investment industry to ensure full disclosure and fair representation of our investment performance. Why does this matter for clients? First, there's a great deal of rigor in auditing to become GIPS verified. Second, it allows you to easily compare our performance data knowing it's held to this high standard. And finally, by hiring a GIPS verified manager, you can have confidence we act in a trustworthy, ethical manner. My colleague Evan Witkowski has written a fiduciary focus paper on GIPS, and it's available on our website. Wespath is launching an alternatives fund for our I series or institutional clients. We constantly seek feedback as noted with our portal enhancements, and many clients have asked for an ability to have more exposure to alternative or private assets beyond what's currently available in the I series. The alternatives fund seeks to provide long-term capital appreciation by investing in private markets, primarily private credit and private equity. Please let any member of the institutional services team know if you have interest or if we can answer any questions. Joining us now is Chirag Acharya, an analyst on our Sustainable Investment Stewardship team. Chirag, thanks for being here today.
Thanks, Joe. It's always great to talk to you.
So I want to start on climate change. We're hearing more and more about it in the news, and with the next UN Climate Change Conference coming in November, it is sure to make even more headlines soon. So many viewers know that climate is an important topic to Wespath, and we have made a commitment to net zero by joining the UN Net Zero Asset Owner Alliance. Can you provide an update on our climate-related work?
Sure, Joe. I'll start by reiterating a very important belief of ours. Climate change is not only a risk to our planet, but also a financial risk to our pension participants and institutional clients. There are broad economic consequences due to physical risk of climate change, such as adverse climate-related impacts on land and infrastructure, and transition risk related to climate change, such as changes to government climate policies, technology, and consumer behavior.
So as climate change is economic risk, we assume that there's going to be a risk to our clients' assets and their portfolios. So what does climate change mean to an investor?
What this means to investors is that they are exposed to the cost of business disruptions and adaptation to climate change, which will impact asset valuations in investment portfolios. Therefore, we are committed to continuing to work with our colleagues in the Net Zero Asset Owner Alliance to achieve the goal of net zero greenhouse gas emissions by 2050. As an example, Jake Barnett, our director of the Sustainable Investment Stewardship team, co-wrote an op-ed in Responsible Investor on why asset owners like Wespath must demand bold climate action from our external asset managers. The op-ed explains the financial and societal risks of climate change and how, as asset owners, we must collaborate and partner with our asset managers on this topic.
So Chirag, why is it important to collaborate and partner with our asset managers? Why wouldn't we just go it alone?
You know, it's important because our asset managers choose the companies in our portfolios, and they conduct engagements with those companies, including voting on climate-related resolutions. They also lobby to influence the economic system. To learn even more about this topic, we encourage viewers to go on Responsible Investor's website and read the free op-ed titled asset owners must demand bold climate action from asset managers.
So it makes sense to work with coalitions and our asset managers so we have a bigger voice and a bigger impact. So how else is Wespath trying to move the needle on climate change?
More thought leadership and using our position to influence action. For example, we spoke on multiple panels at Climate Week NYC, a major summit of climate leaders from the financial sector and beyond. This included a panel talking about the power of investors engaging companies on their alignment of climate commitments and lobbying activity. This is a topic our CIO, Dave Zellner, wrote an op-ed on last year, and it's one that we on the Sustainable Investment Stewardship team continue to prioritize.
So the Sustainable Investment Stewardship team is involved with the Investors for Opioids and Pharmaceutical Accountability, or IOPA. So opioids it's a topic that our clients are very concerned about, and many have seen local impacts. So can you provide an update on the work with this coalition?
We are collaborating with a group of our colleagues in the IOPA on opioids and COVID-19 related safety at various pharmaceutical companies. We have taken the lead role with Rite Aid, which is a drugstore chain, and had engagements with the company in the third quarter. We are also continuing our engagement from prior quarters with Cardinal Health. We met with the company on its recent opioid settlement, its compensation plan, and related proposals during this proxy season. We are now leading and collaborating with a group of our colleagues in the IOPA on creating an opioid disclosure report. This report will allow us to acquire information on opioid-related risks from pharmaceutical distributors, manufacturers, and retailers.
Oh, that's great. Well, we've talked a lot about climate, and we've also talked about an important social issue, but what about some of the engagements in other focus areas? So for example, during the quarter, do we have any engagements related to human rights?
We definitely have. We are leading an engagement with Bookings Holdings, an online travel company, on its human rights program. We led the engagement with a group of our peers and focused on the expansion of its human rights policies, the inclusion of the framework on conflict-affected areas globally, and the company's mitigation procedures. We are pleased to note that Bookings has provided detailed information that aligns with Wespath's values, and we will continue to engage with the company on this topic.
So Shar, I'd also like to briefly speak on the topic of the global COVID-19 pandemic response.
So Joe, we are working on some COVID-19 related initiatives, and we support a fair and global response to the pandemic. That is why we are a signatory to Access to Medicine's Global Investor Statement on COVID-19, which calls for vaccine equity. In addition, the Connectional Table of the United Methodist Church has called on UMC agencies to support a broader church-wide initiative to strengthen the equitable distribution of COVID-19 vaccines. I am pleased to say that we are pursuing additional strategies across our agency to support this effort.
So Shrug, thanks for sitting down with us today and for the work that the Sustainable Investment Stewardship does every day.
Thank you, Joe.
Welcome to the Wespath Market Update for the third quarter. Roughly 90 ago, I started this section talking about the rapid recovery and how we moved to extreme optimism at the end of June. So if you remember, back by the 4th of July, many people were back in the office, there was no Delta spike in the US, and life was really getting back to normal. So perhaps I jinxed us, or I have really bad timing, because we quickly shifted away from optimism after the Delta spike in July. This has delayed many from returning back to work and delayed that normalness that we briefly touched on in June. There are other themes that have raised the level of uncertainty in the markets, such as China's Evergrande solvency issues, and is this symptomatic of a bigger issue with bad debt and leverage in China? There are delays and lack of clarity around the US debt ceiling, also infrastructure, and then next year's potentially $3.5 trillion budget. We have supply chain issues that will last longer than expected, unemployment shortages causing challenges all over the US, and then the resulting inflation that now looks set to last another maybe 12 to 18 months. Lastly, some of the support, or the outside support for the markets, both in terms of government spending and also from central banks, will likely start to be removed by the end of the year. So in 2021, we started the year in the midst of COVID and continuing to work from home, with vaccines in Q1 and Q2 setting the stage for a continued economic recovery. In Q3, the Delta variant has been the dominant theme, And with the other themes I mentioned, we've seen a negative impact on asset prices. So we closed the third quarter more bearish or pessimistic than we started. There are certainly more headwinds and unknowns for the fourth quarter. So let's look at a few data points on COVID, which we believe is one of the main drivers of the policy responses from the Fed and the government. Borrowing a chart from our friends at JP Morgan, looking at the chart on the left, the blue line represents the 7-day moving average of confirmed COVID cases. This peaked at 260,000 in January, and this had fallen to 15,000 by the end of June, which drove the optimism that I mentioned earlier. So infection rates then spiked to 160,000 in early September, but then now have fallen to 85,000 by mid-October. So we appear to have peaked. The black line represents deaths, which also appears to have peaked. So the peak is at least in part driven by vaccines, with the US at 65% of the population with at least one dose. Looking at the chart on the right, this is an estimate of three things: those who've gotten COVID and should have antibodies, those that are vaccinated, and those that have both been infected and have a vaccination. So this upward left to right upper chart is JP Morgan's estimate as to herd immunity, meaning those who should have some level of protection against COVID or at least a severe reaction. At over 80%, it is closer to what has historically been herd immunity and a positive sign for a return to normalcy. Let's look at monetary policy briefly. I started this session with COVID rates because for the past 18 months, the reaction to the virus, fiscal and monetary, has been the biggest market driver. In this case, this is the Federal Reserve Fed funds rates, which has fallen from 1.5% pre-COVID to zero. However, with the economy recovering and inflation moving higher, you can see the forecast for higher rates in 2022 and in subsequent years. Some of the support for the markets is therefore forecast to be less in the next few years. We've shown the Fed's balance sheet in the past. It's basically doubled in response to COVID and is still growing at $120 billion per month. I thought this graph helped show the makeup of that growth in the balance sheet. So looking at the dark blue, this represents mortgage-backed securities, which were being tapered or run off the balance sheet before going into COVID. In response to COVID, the Fed sharply increased its purchases of treasuries and mortgage-backed securities. But for mortgage-backs, it was more pronounced, as you can see here. This has been a major tailwind for the red-hot housing market. And I should add that we now believe that the balance sheet tapering will begin before the end of 2021 and into the end of 2022. Again, this is a level of support being removed from the markets. Let's look at market returns for the quarter and for the year, where we basically had strong numbers on a year-to-date basis, but as we will discuss in Q3, many returns were negative. And that largely happened in September, or the recent end of this quarter. The best performing index year-to-date has been the Wilshire REIT Index. What we don't show here is that for the month of September, this index was down 5%, erasing much of the July and August gains. And it's the worst performing index for the month of September. The REIT sector was hit in September as yields pushed higher, which was driven by inflation fears. For U.S. stocks, let's look at them starting from large to small cap, which is also how they rank in terms of performance, with large cap outperforming small on the year, which if you remember, small cap started off the year ahead of the other indexes. The S&P 500 has risen just under 16% through Q3 and was fairly flat on the quarter. But note that the index lost just under 5% in September, similar to the REITs index. It rose in July and August and then erased those gains in September. The September decline for the S&P 500 is the first since January, breaking an 8-month streak of positive returns. The MSCI SMID Cap Index is just behind the S&P 500 at 15.5% for the year, losing just over 1% in the third quarter. The Russell 2000 or Small Cap Index lost 4.3% on the quarter, and year-to-date, the returns are now at 12.4%. So if you remember earlier in the year, small cap stocks were outperforming large cap. This was on the back of the reopening theme, as they're very pro-cyclical. As the Delta inflections rose and mitigation measures were put back in place, small cap names have been hit and are trailing large cap now for the year. Looking at international indexes, the MSCI ex-US index is up 6.8% on the year, losing 3% in the third quarter, all in September. Again, the international markets continue to lag the US, and there are a few reasons for this, but we also believe there are great opportunities in this sector. In emerging markets, it's a similar story, underperforming the US. And really the EM story is about China, which is roughly 40% of the EM index, and was down 18% on the quarter and 16% for the year. I want to take a few minutes and look at equity charts. We get a lot of questions on if the market is expensive. And it's expensive relative to historical measures, but I want to point out that asset classes can remain expensive for a long time and yet keep moving higher. Also, historically, we've never seen interest rates this low globally, which makes the comparisons more difficult. But in this chart, you can see that the price-to-earning ratio of the S&P 500 was 19.2 times pre-COVID. And at the end of the quarter, even with sharply higher index levels, the PE ratio is just 20.3 times. So why is that? Because even as prices rose for stocks, so did their earnings. And one could argue that the increase in earnings was a significant driver in the equity price move over the last 16 months. So looking at price earnings again here on this slide, looking relative to the last 25 years, currently at 20.3 earnings, we are at high levels historically, but less than the dot-com days. And also, as mentioned, low rates and limited opportunities in fixed income are a factor here. And also note that the PE ratio was higher in recent months and has come in lower with strong earnings of the past few quarters. Last quarter, we showed a chart that showed how the US or international indexes outperform each other for long periods. And currently, the US has outperformed for over 10 years. However, we wish to point out that the S&P 500 is currently more expensive than the MSCI International Index, with the US at 20.3 and the ACWI at 14.3 times earnings. This is a 2 standard deviation difference, and this supports our belief that there are opportunities to outperform in international equities in the next several years. Before we talk about fixed income, let's take a quick look at the US yield curve, as it helps explain the fixed income performance for the quarter and for the year. The top line in blue is January 2020, so pre-COVID, with a higher and a flatter yield curve. The bottom line in yellow is the start of this year, January 2021, so 9 months ago. The curve was flatter and lower than we are because we were still in the early stages of the reopening and getting the country vaccinated. The orange line is the end of September, or the end of the third quarter. So the rise from the beginning of the year until now helps explain why fixed income returns are somewhat low on the year, as rates have risen in 2021. Bond prices have fallen due to that inverse relationship. Let's look at fixed income on the following slide. The broad bond index, the Bloomberg aggregate, is down 1% on the year and was flat on the quarter. But look at the high yield index with just under 1% return on the quarter, but up 4.5% for the year. That is from spread compression, meaning the amount that investors are paid to hold high yield or risky bonds over risk-free treasuries. As investors have sought higher yields or took on more risk, that spread over treasuries has sharply narrowed, pushing high yield bonds higher, the best performer in fixed income. As the economy has recovered, the riskiest parts of the market have outperformed in the US. Now, the emerging markets aggregate is also riskier than treasuries, but has negative returns on the quarter and for the year. This is in part due to idiosyncratic factors in a few countries. So, for example, poor government in Brazil or the increased regulatory situation in China, for example. Low vaccination rates in emerging markets have also weighed, though they are making great strides there recently. Lastly, some of the emerging markets' weakness is really currency weakness, as the dollar has outperformed most of the emerging market currencies. Lastly, note the commodity index at the top of the chart. Dave and I will talk about this shortly, but there are several factors here at play, from supply shortages to huge increases in demand. Also, remember that energy is 30% of the index, and oil has doubled since last year, helping to drive those higher prices that we're all experiencing. That's all for the Q3 market recap. Let's take a look at how the performance of the markets impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Mansko for the update.
Thanks, Joe, and hello, everyone. I'm going to start off the performance discussion by first talking about our flagship balanced portfolio, the Multiple Asset Fund. As a reminder to our viewers, the Multiple Asset Fund has a long-term strategic allocation to 65% equities, 35% fixed income. It's also important to note that there's been no changes to the strategic allocation within the Multiple Asset Fund since our last update. On the slide, you can see the allocation the Multiple Asset Fund has to each of the individual Wespath funds. What I also like about this slide is that it really showcases the broad level of diversification the Multiple Asset Fund offers our investors. The next chart shows the net of all fee performance of the individual Wespath fund composites versus their respective market indices. As Joe noted at the beginning of his update, since we are GIPS compliant, we will be showcasing the composite returns during the webinar, which reflect the combined performance of the I series and P series funds. When I move on to talk about the attribution of each fund, I will then focus specifically on the I series. Looking at the first column, it showcases the third quarter performance results. We did see some market decline in the third quarter that had impact on 4 of the Wespath funds that comprise the Multiple Asset Fund, which were down for the quarter and modestly underperformed their benchmarks. Focusing on the 2 equity funds, which are the first 2 funds listed below the Multiple Asset Fund on the slide, these 2 funds comprise about 65% of the Multiple Asset Fund and were the primary driver of the quarter results of the Multiple Asset Fund. What impacted these 2 funds were stock selection by the underlying active managers. I'll highlight in a moment specific companies that have impacted the performance. Also, the U.S. Equity Fund has an underweight allocation to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw strong gains from these stocks for the quarter. On a positive note, the 2 equity funds allocation to private equity contributed to the fund's performance, as we've seen strong results posted from this asset class for the quarter and also year to date. Moving on to the 2 bond funds, starting with the fixed income fund composite. Looking at the chart, you can see that both the composite and the benchmark were relatively flat for the quarter. The Inflation Protection Fund composite posted positive results for the quarter, surpassing the fixed income fund, but underperformed the fund's custom benchmark by roughly 0.5% net of all fees. Despite the near-term underperformance we experienced from the Multiple Asset Fund, looking at the longer term, the performance of the fund outperformed its benchmark net of all fees for the 1, 3, 5, and 10-year time horizon. Just to highlight as I conclude on this slide is that we've seen a rotation in the markets that started transpiring last year and this year. The stock market as a whole has been up year to date, but the areas of the market that are outperforming are much different than what outperformed last year and even in the years prior. At Wespath, when we make investments and allocations to various asset classes, we make them for the long term. And we don't try to get swayed to make drastic changes in our funds by near-term out-of-favor investments and strategies. As we've showcased, our long-term strategic approach to investing has served our investors well in the long term.
So Karen, I know we like to show the Multiple Asset Fund versus its index, but how did the Multiple Asset Fund perform relative to its peers?
You're right, Joe. We not only like to measure how the Multiple Asset Fund compares relative to its benchmark, but we also want to show how the fund compares relative to its peers using a peer composite that's compiled and maintained by our custodian Bank of New York Mellon. The information on the slide is updated only through August, since the September data is expected to be released later on this month. You can see looking at the chart that the Multiple Asset Fund has outperformed the median foundation and endowment portfolio in the 3, 5, and 10-year time horizon, and performing in the top quartile for the 10-year, which means it outperformed 75% of its peers. In the 1 year, we were below the median, and the reason for this is because relative to foundation and endowments, the Multiple Asset Fund has a smaller allocation to alternatives, such as private equity. In the Wespath funds, we posted nearly 40% gains for this asset class year to date. And foundations and endowments that are part of this comparison likely have 20% or more invested in this asset class, and the Multiple Asset Fund has roughly 4%. We understand that some of our investors would like a higher allocation to alternatives, which is one of the drivers behind us launching our own fund next year.
So Karen, moving on, tell us about the individual fund contributors and detractors for the quarter.
Starting with the multiple asset fund, and I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the quarter was the modest underperformance of the 4 funds that comprise the multiple asset fund.
So I mentioned during my comments that we continue to see strong performance across the broad market year to date, but some equity markets were flat or even down for the third quarter. How did this impact the U.S. equity fund performance?
Yeah, that's right, Joe. The markets gave up some of its return in the quarter, which happened in the month of September, since we saw in August that the markets were at an all-new high. The only U.S. stock market that ended in positive territory for the quarter was the S&P 500, which was up only about 0.5%. This obviously had a negative impact on the U.S. equity fund quarter performance, since the fund has a long-term strategic bias of being underweight large cap stocks, which primarily is mega cap stocks, and has an overweight to small and mid cap companies. And those companies were down 1.4%. You'll notice on the slide that we mentioned the underweight to mega cap stocks as being a detractor to the performance rather than just stating large cap. And the reason is because our fund is really underweight mega cap stocks such as Google, Microsoft, and Apple relative to the fund's benchmark.
So how much is the fund underweight mega cap stocks relative to the benchmark?
The fund is underweight roughly 13% when compared to the Russell 3000, which is the fund's benchmark. Another detractor that the fund had was the active all-cap growth manager stock selection, specifically in healthcare and technology. Companies such as Teladoc and RingCentral were down 37% and 24%, which is quite a difference from last year when these companies posted such strong results. So for instance, Teladoc was up 138% last year. This year, we saw that migration out of growth stocks names into less growthy names, which has impacted Teladoc's and companies like it. But on a positive note, the fund's allocation to private equity contributed to performance, as I noted that private equity investments this year have posted some really solid returns. Next, turning our attention to our international equity fund. The international developed markets did not decline as much as some parts of the U.S. market, but were still down about 0.5%. Emerging markets were down over 7%, which was primarily due to China, which was down 18%, as you noted during your market update. The detractor to the fund performance was similar to the U.S. equity fund, where stock selection by the fund's active managers were the main drivers to the underperformance. Alibaba, which is China's version of Amazon, was down 36%. Also, a German e-commerce company called Zalando, which is an online fashion and lifestyle platform, was down 24% this year after being one of the top stock performers last year.
So it seems like the main driver to stock selection in the 2 equity funds that you just reviewed are companies that were in favor last year and even the year before are now out of favor this year. Is that a fair assessment? And have we seen our active managers make changes to their holdings in light of the stock selection issues?
Last year was an extraordinary year in the equity markets, and I think it's worth reiterating that our investment managers invest in companies that they believe will generate outsized returns over a multi-year period. They do not invest to capture just short-term gains. In fact, one of our most successful managers has been invested in a third of their portfolio companies for over 10 years. This manager likes to say they invest in companies that save time, lives, money, and headaches, or provide exceptional value to customers.
So moving on, looking at the fixed income fund performance, I noted during the market update that bonds have improved slightly compared to the rocky start at the beginning of the year. Specifically, high yield bonds have done well, up 4.5% year to date. Global bonds, mainly emerging markets, have not fared as well due to some of the political issues transpiring in those parts of the world and also the low vaccination rates. How did this impact the fixed income fund performance, given that it has a global fixed income portfolio?
Yeah, it has been quite a challenging year for bonds, with the exception of high yield and U.S. inflation-linked bonds, which I'll talk more about during the Inflation Protection Fund update. As you showcased earlier, high yield bonds are up 4.5% year to date, with other bond asset classes in negative territory. The U.S. aggregate Treasury index is down over 3% year to date and 4.5% for the 1-year time period ended September 30th. So when you compared the yield curves, you can see how yields increased from the end of last year to the end of the third quarter, which had a negative impact on the bond market year to date. It's also worth mentioning that the US dollar increased relative to emerging market currencies during the quarter, which had a negative impact on those allocations in our bond funds. With this said, the fixed income fund underperformed its benchmark for the quarter. Just focusing on the left side of the slide, looking at the contributors, is the fund's overweight allocation to high yield bonds positively contributed to the fund performance, along with issue selection by our emerging market debt and core plus managers. Detractors to the fund performance include the overweight allocation to global and emerging market bonds, specifically emerging markets, as we saw the dollar increase relative to those currencies during the quarter.
So Karen, the dollar had a negative impact on the fund's allocation because we hold non-dollar bonds. So what did we see with the dollar, or why did the dollar increase during the quarter?
There are really a lot of reasons why the dollar's outperforming other currencies. And there are many factors that impact currency movements or valuations. Some could be confidence in our Federal Reserve, confidence in our GDP growth, but it could also be that relative to developed markets, the interest rates in the US are higher. Therefore, the carry trade is alive. I find this interesting. If you borrowed in yen at the beginning of the year and invested in short-term US interest rates, you would have made 8%. The final piece I'll mention before we move on to the last fund, the Inflation Protection Fund, is the impact that our internally managed positive social purpose lending program and commercial mortgage-backed securities, it detracted from the fund. And the reason is because we saw spreads widen in this market sector, which negatively impacted the quarter returns.
All right, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains this year that you highlighted during your update earlier.
Yeah, despite the modest underperformance by the Inflation Protection Fund, it's really showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. So relative to the fund's custom benchmark, the fund is underweight global and UK inflation-linked bonds, which performed well during the quarter. The interesting thing to know about UK inflation-linked bonds is that the duration is quite long.
How long is the duration for UK linkers?
I believe the longest maturity is 50 years. And what this means is that this asset class is very sensitive to interest rate increases. The UK is experiencing inflation concerns like the rest of the world. Therefore, some actions that may be taken by the Bank of England to control inflation, which is to raise rates, could have some volatility for this asset class. Moving on, despite the U.S. Treasury inflation-protected securities having a strong performance year to date and for the quarter, the fund's overweight allocation to this asset class detracted, as it couldn't keep pace with the fund's benchmark, which includes a 10% allocation to commodities. As I noted earlier, commodities were up about 29% year to date and over 6.5% for the quarter.
Yeah, Karen, that's a great point you make regarding commodities. So the Inflation Protection Fund is a 10% allocation as they posted strong results throughout 2021 so far. So I don't see them listed as a contributor on the attribution.
It's a great observation. As I mentioned, the fund has a 10% allocation to commodities, which has been a strong driver to the fund's absolute performance. For the quarter, our commodity returns were relatively in line with the commodity index. Therefore, it did not contribute or detract to the fund's performance. Therefore, it's not listed. The last update before I officially turn it back over to you, Joe, is that the fund's out-of-benchmark allocation to floating rate senior secured loans detracted. And the reason is quite similar for the reason for the U.S. Treasury inflation protection securities and why they're listed on this slide. This asset class had great returns, but senior loans underperformed the fund's custom benchmark.
Thanks for that update, Karen. Let's start out with inflation. During the last webinar, you reported that the Consumer Price Index was 5% or greater for May and June. Since then, we've had 3 more months of year-over-year inflation of 5% or more. You also mentioned that the Federal Reserve was holding steady on rates because it felt that inflation was transitory. So here's what Janet Yellen has said about inflation over the last several months. In February, there's nothing to worry about. In March, inflation was small and manageable. In May, again, she said it was temporary. In June, It could reach 3%, but again, it's transitory. And then now in October, we're told that it's going to be higher for the next several months. So why do you think inflation has been so persistent, and how long will this current bout of inflation last?
So Joe, before I start, if you worked for the Atlanta Fed, you would have just been fined $2 because you used the T word. Last week, the Atlanta Fed president, who so dislikes that word, stated that he will now fine anyone $1 that says it. But before I address the issue of inflation, Joe, I'd like to start out by saying that the pandemic has completely changed the economic playbook. Economists and investors, including us at Wespath, have been trying to understand how the economy and markets will respond and evolve based on the old playbook. The ongoing rapid transformation resulting from lockdowns is rewriting the economic playbook. Where we live, who we see, where we go, how we work, what we buy, all of this has changed, and I mean changed in a big way. Further, I feel confident in saying these things have changed forever. And Joe, I believe there are many more chapters to write, and it's anyone's guess how this story is going to end. We've seen record fiscal and monetary stimulus from the United States and most of the rest of the developed world. We've seen many countries that continue to impose lockdowns and restrictions on the movements of goods and people. For those not aware, type Australia and lockdowns in Google. Australia has the unrealistic goal of zero COVID, and their citizens are paying the price. As mentioned, we have seen massive changes in spending patterns. With the benefit of hindsight, it seems fairly obvious that inflation is a consequence resulting from all of this. So now let's directly address your question, Joe. Let's first look at the overall inflation picture. Regular viewers of our webinar have seen this slide before. The left shows the Federal Reserve's preferred gauge of inflation, the Personal Consumption Expenditures Price Index. The chart on the right is the inflation measure that most of the rest of us follow, which is the Consumer Price Index. It's clear that the Fed's preferred measure is running quite a bit above its 2% average inflation target. And as you said, Joe, the annual increase in CPI has now been over 5% for the last 5 months. I've also shown this next chart before. It's a reminder that 60% of CPI is comprised of food and shelter, things that we can't live without. Throw in medical care, which we certainly can't do without when it's needed, and we've accounted for nearly 3/4 of CPI. Now this next chart is a portion of what I showed during our last webinar. The point that I made when I showed this was that inflation for food, shelter, and medical care seemed reasonably under control, and that the main culprits for the 5% increase in inflation we experienced in May and June were huge price increases in various components in the transportation sector. So Joe, you may ask, what's changed over the last 3 months?
And I'll ask, what's changed, Dave?
So on this next slide, the chart on the left is the exact same May and June data that I showed on the previous slide. The right chart shows the inflation data for the same categories for the 3 most recent months. As you can see, inflation has definitely picked up for 2 of the categories, food and shelter, things that we care most about. Notable is inflation for meat, which has risen 20% in the last year for many meat products. Now you asked, Joe, how long this current bout of inflation is going to last. To answer your question, let's look at trends for what investors and consumers are predicting for future inflation. On this slide, the chart on the left looks at how the inflation views of lenders have changed over the last 3 months. More than twice as many lenders now think inflation will be greater than 4% for the next year. The right looks at consumer inflation expectations, which are also rising. Now, I should note that consumers are usually always overestimating inflation. But regardless, depending on your definition of the T word, it looks like higher inflation is going to be with us a bit longer than we and the Fed may have hoped. I want to show one more slide while we're discussing inflation, where I selected two categories that have seen meaningful, if not dramatic, increases in price. China ships a lot of stuff to the US, and for various reasons, shipping costs have skyrocketed. As you can see in the chart on the left, the cost to ship one container from China to the US is up about 9 times of what it cost just 5 years ago. A significant reason for the rise is pandemic related. A week ago Saturday, the Wall Street Journal had a lengthy front page article about the global supply chain problem. Now, when I say the words supply chain, I'm referring to all the processes that occur to produce and distribute stuff. For example, raw materials are needed to make components, which are used to make products, which must be packaged, shipped, and either stocked on shelves in stores or inventoried in an Amazon distribution center. There are many steps required to put a product in consumers' hands, with a lot of people and transportation required to get them there. If there's a backup or a figurative traffic jam at any point along the way, you've got a supply chain problem. Now, the pandemic started the supply chain nightmare we are currently experiencing. There has been a lot in the press about this over the last couple of weeks. The simple explanation for what is causing the problem is a massive change in consumer spending habits. Because of the pandemic, we are buying a lot more stuff rather than spending our money traveling, going to restaurants, concerts, or ball games. A lot of us have moved and we want to make changes to the new home we purchased. We are also working more at home and want better equipment in our home offices. We are getting to those projects that we've put off for years. Our spending patterns have changed in a big way. Now, the Wall Street Journal reported that continuing lockdowns, labor shortages, along with increasing bottlenecks, are creating backlogs and bidding wars in China for shipping containers overseas. The article indicated that ships going into China must sit offshore and quarantine for 7 days before they are allowed to dock. That's what caused the spike you see on the chart.
So now, Dave, I know we've talked internally about the ports of Los Angeles and having, at one point, I believe 73 ships was a high that are off the port of Los Angeles. But it's more than that, because it's the trucking on the ground, it's rail, where we don't have enough people to move the goods once the ships are even in. We know Joe Biden has come out with a plan last week that's going to look at the ports of Long Beach and Los Angeles and move them 24/7, but there's varying estimates on how much that's actually going to help. It strikes me that it might just be time that we need, but what are your thoughts on that?
Yeah, that's right, Joe. And it's great to see that the administration is working to try and resolve the problem. I've got some charts here to show you on that. The chart on the right shows the path of commodity prices as measured by the Bloomberg Commodity Index. Commodity prices are close to double what they were immediately after the onset of the pandemic, and up 34% this year through last Friday. This must inevitably translate into higher prices for most everything that we buy. I think most of our viewers have seen firsthand the extent of higher prices when they fill up their gas tank, unless, of course, they own an electric vehicle. As I said at the beginning of my comments, we are writing a new playbook. I still strongly believe that increased globalization and technology and the advancements resulting from technology are long-term headwinds for higher inflation. But we may have to resolve ourselves to the fact that elevated inflation could be with us a while longer. So I think I'll stop here, Joe, though this is certainly a subject that we could spend the whole hour discussing.
All right, Dave, so I want to come back to inflation in a little bit, but maybe we can shift to employment in the U.S. So the financial press showed that the Department of Labor's September unemployment number came in at a disappointing figure of 194,000 jobs. This is compared to the 500,000 new jobs that we'd been expecting. But the unemployment rate fell from 5.2 to 4.8%. And it seems that that's nearly half a percentage point decrease. The unemployment rate would be considered very good news. So can you tell the viewers why this report was seen as disappointing?
Yeah, that's right, Joe. Let's take a look on this slide at the 3 key elements of the employment report that was issued by the Labor Department back on October 8th. The chart on the left shows the path of the unemployment rate. Now, it's important to keep in mind how the Labor Department defines unemployment. To be considered unemployed, an American citizen or legal resident must be actively seeking employment. If one is not actively seeking work, that individual is not considered to be unemployed. So hence, the 4.8% rate of unemployment means that 4.8% of those working and actively seeking work have been unable to secure a job. Up until recently, an unemployment rate below 5% was generally considered to be full employment. There will always be frictional unemployment among those that lost their job for whatever reason, or quit to find another job, or just recently decided to move on to something else. However, that calculus has recently changed as the U.S. experienced generational low levels of unemployment immediately prior to the pandemic. This was true across all demographic groups and education levels. As you can see, with the onset of the pandemic, unemployment ballooned to nearly 15% as the country imposed lockdowns and business closures, notably in the hospitality industry, occurred. But as America began to adapt, employment began to recover. This was largely attributable to the change in buying habits, as hundreds of thousands, if not more than 1 million people, were hired by the likes of Amazon, Walmart, and others involved in delivering goods and services directly to your door. We did see some months of lost jobs as various parts of the country saw surges in COVID rates. But generally, the country added hundreds of thousands of jobs each month. But as you mentioned, Joe, economists in the financial media branded the September report as a disappointment. And if you look at the chart in the middle, you can see that the number of jobs added in September was the lowest for any month in 2021. Now, some have considered the light report as a statistical anomaly. They note that the private sector actually added about 320,000 jobs, and the culprit was actually 125,000 jobs lost to the public sector, and noted that this might be due to the way the government adjusts the data for various seasonal factors. Nevertheless, the big concern expressed by many was the drop in the labor participation rate, which you can see in the chart on the right. Remember, one is only considered unemployed if one is working or actively seeking work. If you aren't looking for a job or actively seeking work, then you are not participating as a member of the labor force. Hence, as you can see in the chart, the percentage of the U.S. population working or seeking work remains considerably below pre-pandemic levels. The Wall Street Journal reported that a survey conducted by website recruiter Indeed revealed that the number one reason people gave for avoiding work is their fear of catching COVID. Other factors including parents staying at home to care for their kids, and while schools remain closed, and then there's also a shortage of childcare workers. But I think this next slide gets to the heart of your question, Joe, as to why many consider the employment report as a disappointment. The need for workers has never been greater. There are plentiful jobs that are simply going unfilled. The chart on the left shows that the number of job openings is currently 11 million. And as you can see on the chart on the right, 9 million of those workers can be found among those that, for whatever reason, have removed themselves from the workforce. Now, of course, part of the reason many of these jobs remain unfilled can be attributable to either a skills mismatch or that the compensation is viewed by qualified applicants as just insufficient. Now, I'm going to get a bit wonky here on you, Joe. I ran some numbers based on historical data from the Bureau of Labor Statistics. The lowest unemployment rate ever recorded was 2.5% way back in 1953. If enough people currently out of work found a job to get the unemployment rate down to the all-time low, we would still need about another 7.5 million workers to fill the open jobs. That means we would need to motivate an additional 7.5 million people to join the labor force, meaning that the participation rate would have to go up to 64.4% to get us to a point where all open jobs have been filled. It's been over 10 years since the participation rate was that high. So I think, Joe, that it's fair to say that we've got a long way to go and we'll need some creative solutions to alleviate the shortage of workers.
So Dave, let's shift to the economic growth in the U.S. So the economy grew about 6.5% for the first and second quarters of the year, yet the Atlanta Federal Reserve, who you often reference, is forecasting only 1.2% for the third quarter. So this is considerably below what economists had been forecasting at the beginning of the third quarter. So why have growth expectations fallen so much?
Well, it's the pandemic, Joe. We've talked about supply shortages resulting from the transformational rewriting of the economic playbook, the where we work, where we live, what we must buy, etc. We've also talked about a massive labor shortage. The latest wave of the virus we've seen during the summer has exacerbated these structural challenges. So let's take a look at some of the data. The chart on the left shows the Atlanta Federal Reserve GDP Now estimate for the third quarter at 1.2% that you mentioned. We see quite a significant drop from its 6% estimate that they made at the beginning of the quarter. What's notable here is that the Atlanta Fed estimate has significantly diverged from the average 6.3 estimate of blue chip forecasters from just 3 weeks ago and 3.8% more recently. Now, for those of you keeping score, the Atlanta Fed's final second quarter estimate was 7.9%, which was closer to the final 6.7% GDP reading compared to the blue chip forecast of 9.4%. Now, the right chart looks at actual U.S. economic output compared to trendline growth. I should note that I do not consider the 4.3% growth rate experienced from 2016 to 2019 as being sustainable. Rather, I assume that the economy would have grown at 2% had there been no pandemic. While the good news is that economic output surpassed trendline growth in the second quarter and is expected to remain ahead of trendline growth for the third quarter, the bad news is that we still lost $4 trillion of economic output due to the pandemic. Now, there's more to add here, but I know that you're ready to ask me a question about another question about this topic, so I'll pause here.
So Dave, with inflation high and economic growth slowing, do you think that the U.S. is at risk of stagflation, which is defined as inflation in a recessionary environment?
No, not really, Joe. First, it's probably a good idea for me to define exactly what the term stagflation means. Now, according to Lexico, powered by the Oxford Dictionary, stagflation is persistent high inflation combined with high unemployment and stagnant demand in a country's economy. We have a ways to go before our economy can be defined as in a period of stagflation. Now let's look at each one of the elements in this graphic, starting from right going to left. First, we've only had 5 months of 5% inflation, so check back with me in about another 6 months and we can start to talk about whether or not we've had a prolonged period. Now, we know that demand is not down. In fact, demand is through the roof. Consumers have pent up savings and are anxious to spend. The problem is that they can't buy the stuff that they want to buy because of persistent supply shortages. We are just not going to see a demand shock anytime soon. Now, you could make a case that unemployment is up. Clearly, as I showed a few minutes ago, the unemployment rate is definitely down, but so is the labor participation rate. So if you define unemployment as eligible workers that refuse to or don't have the requisite skills to get a job, then I suppose you could make the case that unemployment is rising. So that brings us to GDP. As I just mentioned, we still have to make up $4 trillion of economic output lost to COVID. But despite the current rate of inflation, and assuming that we don't see a COVID variant resistant to vaccines, heaven forbid, I have to believe that the world will start to address these supply shortages and that economic output will remain robust for the next couple of years. So bottom line, it's just way too early to start worrying about stagflation.
Let's have one more question about inflation, Dave. So even though inflation is the highest rate of inflation amongst developed economies, the dollar has steadily risen, having bottomed out earlier this year in June. So this seems counterintuitive. So why do you think that the dollar is strengthened given the backdrop of U.S. inflation?
Yeah, Joe, you're right. The recent dollar strength is a mystery, and I'm hard-pressed to provide you with an explanation for that. The chart on the left on this next slide confirms what you stated in your question. While inflation has definitely increased in other parts of the developed world, the U.S. does have the highest rate of inflation. Yet, as you can see on the chart on the right, the dollar has actually moved higher from levels earlier this year and after the U.S. reported the second of 5% inflation. What's even more confounding is the prospect of a U.S. debt default absent a raise in the debt ceiling beyond December and the potential inflationary effect of the president's $3.5 trillion Build Back Better spending package. I suppose the best explanation is the differential between U.S. interest rates compared to other countries' rates. Notable, the U.S. 10-year note currently yields about 1.6%, whereas German 10-year bunds remain in negative territory, and Japan's 10-year rate is just barely above zero.
So Dave, in the few minutes we have left, I wanted to shift to emerging markets and specifically China. So there's been a lot written in the financial press about China in the past several months. So these stories, they've centered around the regulatory crackdown that the Chinese governments have imposed, and also the financial difficulties of Chinese property developer Evergrande. So Chinese stocks are down in the mid-teens so far in 2021. So to what extent do these developments threaten Wespath's worldview, specifically optimism for emerging markets, and then specifically to China?
Yeah, you're right, Joe. China has certainly been a lot in the news lately, and it's unsettled the markets. And as you mentioned, Chinese stocks are down in the mid-teens, which contrasts to the double-digit positive gains in the U.S. and many other countries around the world. I think the number one issue remains the coronavirus. As you know, the Chinese have been very aggressive in trying to control the spread of COVID. Lockdowns are imposed quick and often. Compound that with supply shortages, notably semiconductors. Hence, it's understandable that manufacturing activity in China is not as strong as might be anticipated, given the global demand for goods. Now, showing on this screen is the manufacturing heat map for emerging countries that I frequently show. The state of China manufacturing currently is neutral. Now, what is also weighing down on Chinese stocks is increased government regulation and restrictions on certain industries. Notable was its prohibition on profits for the after-school private education sector. Chinese parents are very motivated to ensure their kids are given every opportunity to compete for limited but highly coveted places in the best schools. Hence, they are willing to pay whatever it takes for after-school education resources to ensure that their child can compete. However, China sees a shrinking workforce resulting from its decades-long one-child policy and is now encouraging parents to have multiple children. Given the amount spent educating one child, parents were unwilling to have additional children. Hence, the Chinese government is now prohibiting for-profit supplemental education programs. China has also adopted regulations limiting online video game playing for young people to 3 hours a week. There are a number of other rules on the technology sector that's being imposed by the Chinese government. And then there's Evergrande. Again, we could have filled up our entire time talking just about Evergrande. In a nutshell, this is a company that, as they say, got ahead of its skis. The company is the second largest real estate developer in China, but it also operates or has significant ownership interests in a lot of other businesses, such as theme parks, electric vehicles, insurance, retirement communities, mineral water, and it also owns a soccer club. It borrowed boatloads of money to the tune of $300 billion, and it's having difficult time paying all this money back. It has a lot of apartments vacant or still under construction. It could go bankrupt and dump a lot of housing inventory on the market, which would have the effect of depressing housing prices. Now, the problem here, Joe, is that housing represents by far the greatest proportion of the average Chinese citizen's net worth. And if they were to see the value of their homes drop, then you are going to have a lot of unhappy Chinese. Again, it's anyone's guess as to how this will ultimately resolve. I am a bit worried about this, Joe, because the experts are pretty much dismissing the possibility that this is China's version of the 2008 U.S. housing bust. I confess that I just got around this weekend to watching The Big Short for the first time. Now, for those of you that haven't seen the movie, it is the story about a group of investors that discovered that the housing market was a house of cards, or Jenga blocks for those of you that did see the movie, and the Jenga blocks about to collapse. Now, prior to the U.S. housing market crash, all the experts thought that the housing market was strong and a crash was nearly impossible. And we all know how that story played out. All that said, I still believe that the long-term story for China is bullish. But this certainly is a story that bears watching.
Great, Dave. Thanks for that update. Thanks for being with us today. That concludes our third quarter Wespath webinar. Thanks for being with us today. If you have any questions, please email us at investmentinfo@wespath.org.